Okay, we're just back to cable again, and as I said, we were waiting for what was going to happen at the London Open, and needless to say, the usual happened. As I said, we had this nice move lower from just before 6 o'clock here. The VPOC, as I explained, is dynamic. We had the move lower, then we had this little sort of a consolidation congestion phase up to coming up to the open. Pairs often do this either at a significant session crossover or before a piece of fundamental news. The move lower was also accompanied by two, well, actually 4 volatility candles, which sort of tells me maybe the pound is coming up for some volatility, both in terms of momentum, but in terms of because of, as I said, there's Brexit, there's the virus. I mean, you know. Take your pick basically. So for me, it's going to be a nice currency to have a look at for the rest of the month, not just in cable, but in some of the cross pairs, which do can move very, very nicely. Then, as I said, we had the move sideways. It looked as though it was going to move lower. Then we had just before London, we had this looked like to be a reversal. We had this sort of looks like a 2-bar reversal here, but look at the volume under that up candle. If if there's one thing that VPA will tell you is, do you have an agreement between the price move, the result, if you like, of the it goes back to Wyckoff's third law of effort and result. So we've had this effort to rise. We have this big candle, which is almost a bullish engulfing, a 2-bar reversal. But look at the amount of volume underneath it. It is not consistent. It's not congruent with what that candle, the spread of that candle. And given when it happens, just before the London Open. So what happens is, after this relatively long move in terms of a 5-minute chart, a lot of traders would be looking for, it is natural to think it's a reversal. Maybe it hits a some kind of metric that they use for significant levels, their support and resistance levels. Maybe it's I don't know, it could be a Fibonacci level. Take your pick. It could be even a moving average. And you say, oh, great. And they see the candle pattern. They don't look at the volume. They just look at the candle pattern. They don't perhaps are not aware of the open of the London session, and they think, oh well, everything seems to line up. And we have a habit as traders of, when we come to a point on a chart, it doesn't matter what the time frame is, there has been a decent move, however you classify it. Oh well, it's had a good run down. Oh, it's got to reverse. Or it's had a good run up. Oh, it's got to reverse. And that's quite a dangerous way of thinking, because yes, there will be corrections, there will be reversals, but markets can carry on in the same direction, can be oversold and overbought a lot longer than you and I can stay solvent. So from a technical perspective, you think, yeah, great, it looks like it's going to reverse, but what gives it away is the lack of volume in the move higher. We then have a pullback on this candle here, as we see here, a small candle, a reasonable amount of volume underneath it, but it doesn't go anywhere. And you've also got a wick to the top of the candle, but it's the next candle which is if you like, the clincher, and that is you have this huge effort to rise. It crashes back down, and look at the volume underneath. And I appreciate that's obviously you also got the inrush of volume that you would get with the London Open. Anyway, you're still in the volume point of control. The question now is this volume point of control, is it going to be a region where it's going to act as strong support, or is it actually going to act as a further resistance to this move going high? Now, what would happen here, the reason why so many traders would be taken out, is they would see this and say, all right, time to go long. they would put their order in. Their stop loss, I suspect, would be somewhere below the wicks of these candles, and they think, oh right, that it looks like it was going to go up, go back to test. We have the volume point of control here, and then bang, that's where the stocks would be taken out in this candle here. Now there's been buying under this candle here, as we can see. What's also interesting, it's very close to 2260, which is actually the S3. I suspect, it's only a suspicion that I have, is that I suspect there are a lot of limit orders around a 2260. 2260 also corresponds with, let's have a look at the 60-minute chart, which tells us, which is, I think, was about yesterday's low. Let's see here. Let's have a look here. Yeah, it's just, I think that came just below 22, but it's a nice round number. So, you know, it is feasible that there would be, this markets work on, how do markets move? We go to what we call order flow, and order flow is something that David and I will be looking at and looking to teach in a bit more detail later on in this year. But essentially what it is, order flow level 2, it's where the institutional orders, where the big orders sit. And as retail traders, you can get this data, but unfortunately now you do have to pay for it. But if you just bear in mind that most of these orders, or in all markets, all sit around nice round numbers, and in forex it's around 0s and 5s. So around 2260, there's possibly a load of institutional orders. In other words, orders have gone into the market. Even retail orders may be thinking, oh right, well that's the low. That's possibly a good, a good demand area, a good area that I'd like to buy. Now, how does the price actually get there? Well, it doesn't get there by itself. It gets there via market orders. It gets there because retail traders maybe don't use limit orders. They're impatient. They see a technical setup on a chart and they just want to get in. They want to get some of the price action. But also institutions themselves, they may set limit orders in. Some of them may be spoofs, and they will then use market orders to drive that price to that particular level. Or they are in a situation, we have to remember this market is a very practical market. You know, banks have to, they're constantly exchanging for their clients. They've got commitments and there's huge volume. So they may have a limit order at a particular level, but you know what? They think, I can't wait for that. I've got to have it now. That's what moves the market. That's what drives the flows to those particular levels. The change of sentiment, as I said earlier, particularly with the yen, that there has to be a switch. That maybe sentiment changes, and so there has to be a switch between buying and selling. So you can forget limit orders. That has to be done now, and it's the market orders which move the price to the limit orders. Now, when you're at this limit order, you know, there are these limit orders, then the battle begins, as it were, Are they going to be fulfilled, or are they going to be overwhelmed by a fresh wave of selling? Now, at the moment, it looks like the 2260 is actually holding, and this is why our indicators, such as the developed with the CSI, they pick up these flows. So if I move that down to maybe a 5-minute chart here, what can we see? Well, actually, we can see, you know, this looks like there's a reversal here. There is buying, pound buying. The dollar is also turning over. So taken together with why we know these, you know, how and why these prices move, these pairs move, taken together with an indicator such as the CSI, and having a look at the matrix, looking at the pound pairs for the matrix to say where is the strongest buying of the pound at the moment. And it's clear, well, it's actually in the pound yen. The cable is moving, but certainly not as much as the pound yen. But the numbers, these values that this indicator comes up with, also gives you a clue as to the strength of the move that we are in at the moment. So it just might be a creep higher. And what we want to see is these numbers obviously going higher, or if there's not going to, if it's going to go in the other direction, it will go, you know, it will fall and you get a minus number. Now, what's interesting is the New Zealand. The New Zealand, while I'm not interested in the New Zealand at the moment, because as I said, my focus today and probably for the rest of the week and the month is going to be on the British pound for the reasons that I've given you. But you know, the market is buying the Kiwi. We know that. If I just put the Kiwi up, just isolate it out, in fact, it's taken all the bottom spots here. And look, we have divergence in the pound New Zealand. We've got strong pound buying, but in the pound New Zealand, the driver there is more on the New Zealand side. And what's also interesting is they're kind of moving in the same direction. There's also a divergence in the numbers. We can see here +11 to -6, so there is more, if you like, it gives us a sense of the strength, if you like, for the buying and selling of this particular currency. And we use these numbers as an indication of, as I said, the strength of flow into the individual pairs. I think that's what I want to say about that. David, is there anything you want to add to that? All right.